Welcome back. Paul Black is the co-CEO of US global fund WCM, which has been a chronic market outperformer for many years. Its unique investment strategy has attracted some of Australia's most well-known super funds, and for the first time, WCM will be available to retail investors looking for overseas equities exposure via a new listed investment company called Contango Global Growth. And Paul joins me at the desk. Paul, great to see you.
Thanks very much, Peter. Great to be here.
And I should point out that, our organisation is sort of helping you, promote this fund in Australia, and we'll be beneficiaries. But from my point of view, it's an education program because it's a very interesting fund. The point I'd like to probably start off with is that Australia's only got 2% of the world global market. So in many ways, if we only invest locally, we're missing out 98% of investment opportunities.
Oh, absolutely. And that 2% really is focused in basic materials and financials. So when you think about the world and what we do, we stay focused on those kind of global growth companies, which tend to be in the consumer area, the healthcare area, and the technology area. So you're really missing out if you just stay local on a big part of the growth that's going on around the globe.
And what is a really interesting statistic is that IT stocks in the US make up 22.5% of the US markets, and it's 1.2% here. So if you want to get that kind of exposure, you have to look outside.
You have to go outside. You have to go outside. That's exactly right.
How long has WCM been operating?
We've been around for over 40 years. We started in 1976, but the actual firm that exists today, which is about $23 billion, started in 1998 when we bought out the original founder.
Why Laguna Beach? It seems so cool to be in Laguna Beach.
It is, and you know what? People in New York and San Francisco and Chicago and London think that we're remote and we have a disadvantage, but we're big fans of what Warren Buffett talks about all the time. There's a huge advantage being remote because you don't have to put up with the noise and the chatter and the short-term thinking that goes on in those major cities. It's a fantastic advantage for us.
Okay, so talk to us about the union between yourself and Contango, because historically you've operated through super funds in this country, but this is the first time that you've taken what you guys do to the retail market.
No, that's exactly right. In the United States and North America, we've been really a dominant player in the institutional market. A number of years ago, we launched a US-based mutual fund and had a lot of success going to the average high net worth and retail investor. So we thought that based on what's going on in Australia, it might be a lot of fun for us to launch a fund, and we did it through Contango because they do the heavy lifting. We just run the portfolio and run it like any other mandate.
Which is a fairly important thing. You've got to run the portfolio effectively.
You do.
Tell us about, because as I said in the intro, you've been a chronic outperformer.
Yeah.
What's the investment strategy that explains your consistent success?
There are a number of factors to it, and really what we do, I think, is very different from most people that manage money, certainly on Wall Street or any street. The typical investor will look for wide moat businesses selling at a discount to intrinsic value. What we do that's very different, and that's very Buffett-esque, but it's very difficult to find inefficiencies in that market because everybody in the active space is doing the same thing. I think it's one of the reasons that active managers chronically underperform. It's because they're all doing the same thing, expecting different results. What we do differently around competitive advantages is that we focus on the direction of the moat. Everybody's competitive advantage, every business's moat is either getting narrower or wider. And we stay focused on those types of businesses where they're expanding and getting stronger vis-a-vis everybody else in their industry. If you do that and you get that right, it's a huge add to the overall performance. And then you couple that with doing a lot of work on the culture of the business, because at the end of the day, what allows one business to outperform for long periods of time has to do with the people in the organization and the values that are at the core of the business. So if you can find a business where the core values are aligned with the competitive advantage, you've got a company you can own for a lot of years. It's going to compound wealth for a long period of time.
So I know that Amazon has been one of the companies that fits your moat analysis.
Right.
But once upon a time, Nokia, or as you pronounce it, Nokia, it looked like that. How do you know when to say that moat strategy is no longer working for that company?
That's a great question. In 2007, if you asked the average analyst on Wall Street or any street, is Nokia a high-quality, wide-moat business selling at a discount to intrinsic value, everybody would have said yes. You know, I would venture to say that 23 of 25 bankers had buy recommendations on it, and yet we all know it ultimately destroyed a lot of capital. You know, you have to be able to do a lot of comparative analysis and a lot of pattern recognition to identify when economic moats are declining. And in the case of Nokia, it was pretty obvious when the iPhone came out and then the Android came out, so which allowed a lot of cheap Asian phones to be manufactured. That was a massive kind of headwind for Nokia, and ultimately it proved to be, it led to its destruction.
Paul, what's the process? Because obviously you don't get these kind of results consistently unless you have gone looking for the smartest guys and girls in the room and then dragged them out of the room and taken them to Laguna Beach. Yeah. But what is the process? Is it a very aggressive process where you actually take each other on and raise questions about your assumptions about businesses and things?
Not really, because what we're looking, you know, people think when you're investing globally, you know, that it must be difficult because there's so many public companies in the world.
And you're not just in America, you're all around.
No, we're all over. You know, we're in Europe, we're in Asia, we're in Latin America. It just, you know, for us, because what we're looking for is so specific, expanding moats, selling at a decent price with cultures that support the economic moat to grow. By the time those names percolate to the top, and we've done that in a very collegial way, there just aren't that many ideas, so there's not a lot of conflict because it becomes very obvious, you know, in our portfolios that we need to put a particular name in.
So do you worry about external issues like the outlook for the global economy, what Donald Trump might do to tax reform in the USA, which then could have an impact on your analysis on an individual company? Are they big issues for you?
They're not, and they're not. And the reason for that is we don't believe anyone at the end of the day can accurately predict where interest rates are going, where GDP growth is going to be, what the Federal Reserve will do. You know, the old saw is if you're going to make predictions, make a lot of them because you're bound to get one right. But the truth of the matter is it's very, very rare that people get predictions right. So from our perspective, again, just like Warren Buffett, buy really high-quality businesses with expanding moats, supported by a culture. Let those businesses work for you. Give them time, 5, 7, 10 years, and they'll create an awful lot of wealth.
And how many companies do you have in your portfolio?
We have 33 companies, so it's a very focused strategy. And it's interesting because people will think 33 companies must be riskier than the markets, and the truth of the matter is it's not, because we've done a good job on identifying the right types of businesses. So in difficult markets, we only get 55% of the downside in those markets, and we participate on the upside.
And I've read that you have a thing, a strategy called downside capture. Is that right?
That's right.
So just to the layperson, what does that mean?
That means if the market over a 3-year period of time, or let's say over a year period of time, goes down 10%, obviously what you want to do as a manager is not go down as much. So typically, in periods of time when the markets go down 10%, we're only going to go down 5%. Now, when the markets go up, we typically get more than the market when it goes up, and those numbers work. You lose less than the market in difficult times, and you do very well in rising markets. You will have a very good compound rate of return over time.
So what's your hope and expectation for this fund? You know, given the kind of outlook that you see, the kind of companies that you've historically recruited for your portfolio, what do you see for this Contango Global Growth?
Our expectation,
investment company?
right. Our expectation, one, is that it's a great offering for the average Aussie because it makes sense and it opens up the world in terms of growth. But our expectation over time, historically, we've beat the market by about 500 basis points or 5%. We'd expect to do somewhere around 3 or 4% better than what the market does. So if the market does 9%, we'd expect to do 10, 11, or 12.
Well, Paul, great to meet you. And now you're sort of a part Aussie. We might see you more often down here.
Love to. Love it down here. Love the people.
Great stuff.
Thanks
for
very
coming on
much.
the program. That's Paul Black from WCM. If you want to know more about the fund, you can go to contango.com.au.